No long intro. Market analysis. Less is more and usually more effective. Now, this is a concept I've been working on incorporating into my own personal trading for the past year or so. And I must say, I've seen some of the best results so far in my trading. Although at first, it seemed counterintuitive because on a surface level, it appeared to me that the more complex a system is, the better it is, which is a logical conclusion for any rational being to come to. But although it's a fallacy, it's simply not true. And Nassim Taleb said this. Some of you may know him as the author of books like Fooled by Randomness and Anti-Fragile. He is also the individual that coined the term that now is widely known as Black Swan Theory, which talks about rare events that we don't have any reference to in the past that usually when they come is very hard to predict and even harder to compute, no matter how intelligent someone is. Now, this morning, I was rereading one of his books, Anti-Fragile, which by far to me is some of his best work. And one of his passages resonated with me. He said that time is functionally similar to volatility. The more time, the more events, the more disorder. Consider that if you can suffer limited harm and are anti-fragile to small errors, time brings the kind of errors or reverse errors that end up benefiting you. This is simply what your grandmother calls experience. The fragile breaks with time. And for today's mind map, I will attempt to actually strip down some of my trading to show you guys that less is actually more and it's way more effective. And let's take a closer look at this quote itself. He mentioned that time is functionally similar to volatility because the more time, the more events, and let's replace events with trades. The more trades, let's say one take, consider that if you can suffer limited harm, meaning your losses aren't devastating. They're not going to affect your trading and hinder you from further trading. Then you can actually continue trading and gain from those experiences. Only then are you anti-fragile to small errors. And that's one of the things I've experienced in my own personal trading. Sometimes I would risk 3% on a trade, and I simply, at the time, could not afford to lose 2%. So you can imagine how much that would change my mindset and the way I view trading. He also mentioned that time brings the kind of errors or reverse errors that end up benefiting you. Now, that's the same thing when it comes to your small losers. Assuming that you actually journal your trades. When you're trading, those small losers, although they are painful, but the experience is so valuable. Something that you can't necessarily pay a mentor to teach you. You actually have to get into the markets and gain experience for yourself. And although I find this part of the quote to be quite comical, he mentions, this is simply what your grandmother calls experience. I think that's very funny because it is true. And at the end, he mentioned that the fragile breaks with time. And while reading that, I simply thought to myself, well, no. Like, as a trader, that's the last thing that should be happening to you. As a trader, you should only be getting better with time. But you only get better with time if you are anti-fragile to small errors, to small losses, not to 25% losses on your account on one trade. If you're losing that much in one position, then you become fragile. And of course, the fragile breaks with time. Although as a trader, we want to be anti-fragile. We want to be able to suffer limited harm and those small errors. Because if we use time as volatility, or like he mentioned in the beginning, time is functionally similar to volatility. It simply helps us and actually helps us benefit in the long run. And that's exactly what experience is. Assuming you're journaling most of your trades, those small losers, no matter how painful they are, you remember them. You remember what you did wrong, what you did right, and you can keep on improving. But if you're risking too much and you're not suffering limited harm, you're suffering unlimited harm, you're trading with no stop loss, it's only a matter of time before you break. Take a look again. He says, the fragile breaks with time. Now I remember the first time I was reading this book, there was an example he gave, although I don't have the specific quote in this mind map. It went something like, imagine someone threw a 25-pound rock at you, full force. Now that would cause some serious damage. Assuming it hits you in the head, probably get a concussion, maybe even break your skull open if it has enough volatility in there. Now, he gave such a clever way to even understand this. He mentioned that, let's imagine now you split the rock into, let's say 1,000 or 100 pieces, smaller pieces, and you actually throw this at someone. No matter how hard you throw him at someone, as long as it's by hand, it's not you don't put it in a machine, the harm is limited. Like throwing 100 pebbles at someone and throwing a 25-pound rock is completely different. And I remember thinking to myself, oh my God, this is so clever. How do you even think of this? And then it clicked. Well, if I have small losers, limited losers, and I can gain from all the experiences from those losing trades, from those errors, then I'm going to be way better over time than having those 5% losers, 10% losers that if I have 4 of those, my account is pretty much gone. And the way he was able to draw that example and actually made me understand it was so clever, and I'm easily impressed, that is, but that was so clever for me, and I hope you guys do understand this example too. It is a lot better to have 100, 1,000 pebbles thrown at you than to have a 25-pound rock launch at your head. It's very different. The same way for trading. The pebbles, they hurt you, but you're anti-fragile. You're not hurt by them. They're not going to destroy you. But that 25-pound rock that hits your skull, it does break you and probably cause some irreversible damage too. Now, let's take a look at some of our seasonal tendencies for next week, because I know a lot of you, that's what you guys are here for the market analysis. But it is important to keep this framework in mind, becoming anti-fragile and limiting some of the harm that can be done to you, because in the end, there's only one thing you can actually control. You can only control your losers, how much you're willing to give up if the trade doesn't go your way. Nothing else. You can't control the winners, but only the losers. Now, for seasonal tendencies, we talked about this last week. Although today we're going to be specifically talking about the euro dollar. We won't take a look at the other seasonal tendencies. I showed that all last week. So I'm going to be practicing what is less is more. So instead of taking a look at all these markets, we'll simply take a look at the euro dollar. Now, let's take a look. This is the seasonal tendency for the euro dollar. And if you guys are remembering from our discussion last week, we talked about how ideally there is a high that forms and right in between mid-October here, and after that we have a sell-off going into November. And that's exactly what we've been seeing happen for the past couple of weeks. We're seeing the euro dollar rallying quite a bit, And now we're expecting lower prices from here on all the way till November. And once we get to this point, we actually talk about our next quarterly shift. We'll also be taking a look at the weekly profile. Keeping in mind we're still bearish for the euro dollar, and we'll be expecting to have Tuesday have the week form this week. When we actually take a look at the charts, I'll be showing you guys how I would actually like to see previous week's high to be taken out while price is trading at a premium. And most importantly, the economic calendar, because this actually made me sat down most of the week last week, and I only traded 3 days, and I didn't trade on Wednesday or Thursday, but that won't be the same for this week. So a lot more opportunities for this upcoming week. So now let's take a look at the charts. Let me pull up the charts for you guys. Right here. Let's see. Let's delete all this. If you guys remember what we mentioned last week, mentioned that I'm expecting this to be that actual high in October. That was the rally we're expecting, and it did so while filling in the fair value gap in here, while trading into the order block in here. So it's very unlikely that price goes back above this weekly high, although we are expecting price to go above this weekly high. So previous week's high, I'd love to see it taken, like I mentioned in the mind map. Take the previous week's high, and let's actually show you guys why I'm advocating for this. Price right now is right about at equilibrium. I'll put the notice these highs in here. When we drop down to a lower time frame, you guys will actually see this start to shape up really nicely. So this will be your drawn liquidity in here. And this is actually previous week's high. So we have a fair value gap in here that would love to see price trade back into. We also have previous week's high. So assuming that price actually does trade up here, take out previous week's high while filling in this SIBI. And notice this, we have a big old order block. Now, I actually enjoy this part of trading. Now, this is the mean threshold of our order block in here. And I do hope you guys notice this. So right there on the 79% retracement level. or what ICT calls the optimal trade entry. Although I'm not really a big fan of optimal trade entry, I've used it earlier on in my development, but it never became my go-to. But I know some of you guys really like this, but the fact that it's layering really nicely like that, I'd love to see price trade into this right in here. And if I could go short in here and holding for lower prices like the seasonal tendency is likely to do. Now let's drop to a 4-hour chart. Let's adjust this. Notice in here, these two candles are equal highs in here, and we have a lot of highs in here. So chances are a lot of people that trade supply and demand are assuming this is going to be resistance or supported resistance. Whoever believes in that kind of trading, they'll probably thinking this area right here is resistance. So very likely that the market trades into this. I mean, this is one of the those trades I'm actually very excited about. Although it is worth noting, guys, that we have an order block in here, so very unlikely to see price trade lower before heading here. That's why I'm expecting Tuesday high of the week to form during London Open, because chances are I'd like to see price move higher throughout tonight's London session and Monday's trading, and essentially stopping somewhere up here at a premium at the 79% retracement level, and then start to trade lower like we're likely to do seasonally. The reason why I'm actually very strong in this idea too is because that we had a consolidation in here, and those are some of the best order blocks to use, the ones that are inside of a range right at equilibrium. Let's see if I can quickly draw that. Do hope you guys notice how price respected that. This is the equilibrium of this range, and we have this order block in here. Although I'm open to the idea that price may trade deeper into this order block, I wouldn't mind that, but chances are it won't. And right now, ahead of London Open on Sunday, right now we're seeing price trade lower. So I'd actually like to see price trade lower, form some sort of a Judas swing into Monday's Open, into Monday's New York Open, and eventually trade higher for the rest of the day until our Tuesday London Open, where it forms the high of the week. Ideally, that's what I'd like to see, but let's see if the markets want to play nice. Now let's drop to a 1 hour time frame. This is the daily fair value gap in here. Notice that. Very likely that price trades in there. And here are the relative equal highs, and we have those equal highs also. And this is previous week's high. So I'd like to see previous week's high taken, and then see price trade lower in confluence with our seasonal tendency. So I'm actually very excited about this week's trading. I know some of you may want to look at some other things. Let's see if I can take a quick look at the CAD. Nothing interesting here, but we have relative equal lows here. And the CAD itself and the euro dollar are inversely correlated, so I'm expecting higher prices on the dollar, which means I'm expecting lower prices on the CAD. It's hard for me to find entries on dollar CAD, but I'll still be keeping a close look on it, because in all likelihood this thing does trade lower, potentially settling inside this fair value gap. And we have a 3-bar 3 down close order block in here. I think if you would go on a daily chart, this would most likely be an order block. Let's take a look. Yeah, for sure. Yeah, there it is. That's pretty. So we have the daily order block in here. So in all likelihood, price does trade lower into this order block, and then eventually see price start to rally, because the CAD itself has an even stronger seasonal tendency to actually rally. It's actually better than the euro dollar. That's why I'm still keeping a close eye on this, and I'd love to actually get an entry on here. I could potentially even go short and then long, but whichever one I'll be fine with. And these are the two markets I really only want to take a look at. Nothing else is interesting to me. I'm keeping it simple because less is more. And like Nassim said, it's usually more effective that way. So I don't want to over convolute my trading with looking at, let's say, 20 different pairs. It's simply not worth it. I don't have the mental capacity to be handling all that price action anyways. But these two markets I can keep a close eye on. Although I didn't look at the dollar, I'll do that on my own spare time. I just wanted to give you guys a look at what I'm potentially looking forward to for next week. Let's actually take a look at here's the crude template from ICT, your classic Tuesday high of the week, and then love to see price start to trade lower from there. And that'll be it for today's video, guys. Although it is worth saying that the economic calendar will play a big part in this week's trading. So none of this really matters if you're not paying to the economic calendar and actually being able to frame some of your trades properly. So what I'm looking to see for this week is we're still bearish on the euro dollar, although we're expecting Tuesday high of the week to form. So from now until Tuesday, I'll probably like to see higher prices. So I think I'll be trading Monday morning New York session, anticipating price to go higher. So I'll look to go long. If there's any entries, I'll definitely take that. I'll be staying long until price takes out previous week's high and actually does trade into the premium we talked about. That 79% fib level, that's also layered on top of the midpoint on the order block, the mean threshold on the bearish order block. So all that is a really good framework for a really good setup for next week. And that's really all you need. You may think that it's not enough. You want to look at more pairs. You want it to be more complicated, more order blocks, breakers, all types of stuff. But for me, frameworks like this, keeping it simple, is very effective for me, because now I have a simple framework. Tuesday high of the week. That's what I'm expecting. That's what I like to see. And although I'm really good at adjusting when things don't necessarily go my way when it comes to the weekly profile, if anything changed, I'll be sure to actually update you guys on a video. But as of right now, this is what I'm looking at. Let's take a look at Nassim's quote before we leave, because this is very important. It's actually one of the things I'll be incorporating into the channel later on down the line, is becoming anti-fragile. That's why I'm reading this book a second time around. I'll probably read it half a dozen times before I make my actual video on the actual book. But let's take a look. He says, time is functionally similar to volatility. The more time, the more events, the more disorder. Consider that if you can suffer limited harm and are anti-fragile to small errors, time brings the kind of errors or reverse errors that end up benefiting you. This is simply what your grandmother calls experience. The fragile breaks with time. Keeping in mind the difference between a 25-pound rock or 100 pebbles. It's the same rock, it's the same thing, but when you break it down, one causes more harm than the other. Risking 7% of your account on one trade causes way much more harm than risking 0.5%. And the thing is, it's not linear. That's the issue when it comes to this. It is not linear, so it's not like when you add more to your positions, you can actually calculate how much you'll be losing, because it's so hard to actually calculate the secondary effects. Not only does it harm your equity and your balance, psychologically, it affects you a lot more. So that's why it's not necessarily linear when it comes to risking so much on your accounts. Although Anti-Fragile is one of those books, I would love to make a video on this. But for today's video, I'll keep this short and simple. So higher prices for the first part of the weekend. Hopefully Tuesday have the weekend lower prices for the next few weeks, in tandem with our seasonal tendency that we have right up here. So we're looking for lower prices all the way throughout November, and we'll change that when we get to the end of November. Now, I do hope you guys found today's video to be helpful, and see you guys next time.